Well, the book is a collection of contributions from several authors, some coming from continental Europe, from the UK of course, America, New Zealand, all of them addressing a very important topic, a very timely topic, which is the creation and the implementation of the European Banking Union. And one of the most relevant things about the book is that it's not just being written by academics, but also by practitioners or former members of the staff of central banks. So it is indeed a very interesting book for people interested in these subjects. After the global financial crisis in 2007 and 2008, it was very clear that particularly those peripheral economies in Europe suffering from a banking crisis had to bear the cost of the rescue or the bailing out of the banks or their own financial systems. And this made the already very weak financial position of those governments even weaker and weaker. So this imposed a sort of an extra burden on those economies and also the risk of a contagion to the other members of the Eurozone. So why not harmonizing the supervision and the regulation of banks, so we all the Euro member states could keep an eye on banks and possibly resolve them in a better fashion in the future. That was the most important concern at the time. The other one was the degree of solvency of the banks at the time. It was very variable across countries. So again, why not trying to set out common standards all across Europe? That was the other major concern at the time. There is no such easy definition of a banking union because traditionally, because the European Union is an exception, traditionally we didn't have to define it. We had a very simple structure of a single country with a single treasury or a single budget in the hands of the Chancellor of the Exchequer in this country, for example, and a single monetary regulator. So there is no set need of a definition of a banking union of several jurisdictions under the same rule. It was already in place by default. But in the case of the European Union, we have now many countries, very diverse countries, sharing their own banking structures. So indeed, we need to work on the definition itself. A banking union can be defined as a market for the banking sector, for the banking services sector, in which there is a single regulatory framework, so single rules for all of them, and a single regulator. Those are the major characteristics of any banking union. So that ideally, it would be for all the agents operating in the European Union to go to any other country and be able to borrow money and to lend out money freely without any obstacle, any regulatory concern or obstacle whatsoever. So yes, indeed, the European Banking Union goes in this direction, but it hasn't removed all the regulatory national obstacles. Well, first of all, it is an asymmetric banking union. By asymmetric, I mean that not all the European Union member states are equally affected by it. So the most striking example is the United Kingdom. Some of the institutions that I will talk to you later perhaps about only affect the Eurozone members and not the rest of the non-Eurozone EU member states. That's one of them. The other major concern or flaw about the European Banking Union is that it will be fully operational in 8 years' time, by 2024. So what will happen in the meantime in case of another financial or banking crisis? We don't really know yet. And finally, the true test will be the next financial or banking crisis. It's very easy to put it in writing that these new institutions are going to be ideal and they are going to tackle the new crisis, but we need to see that in practice. One is the adoption of a new capital requirement standard all across the banking industry. So all banks in the EU, and this affects obviously the the United Kingdom, all banks should have the same capital requirements. And the institution in charge of this is the European Banking Authority. And again, this is imposing the same standards all across the European Union countries. The other new mechanism available by the European Banking Union is a single supervisory mechanism, but this only affects Eurozone members. This means that the European Central Bank in Frankfurt will be regulating and will be supervising all transnational, cross-border banks in the Eurozone, and the biggest banks are going to be supervised now by the European Central Bank. This is a major step towards the harmonization of regulation and supervision in the European Monetary Union. And finally, there is a new directive. It is the Bank Recovery and Resolution Directive, by which, in case needed, in case there is another banking crisis, every single country in the European Union, the UK of course included, must have a sort of a national plan for an early intervention in the market. And on top of that, every single nation must have what is called a resolution fund, by which it's going to be the industry, the banks, paying for a fund to be able to pay for the cost of another banking crisis in the future. This is a major change in the regulation. And finally, in case this money is not sufficient to pay for the cost of the resolution of the bank, it will not be taxpayers' money involved in the rescue of the banks, but it will be in the first place the bank's creditors' money, which is going to be bail-in as opposed to the bailout traditional policies. These are the major changes to the current regulation. It's not going to be taxpayers' money in the first place that is going to be used to pay for the bill. It's going to be, first of all, the fund that is going to be paid by the banking sector in the first place. At the same time, it's going to be the creditors' money and not depositors' money or taxpayers' money. And only if those two funds are not sufficient, it may be the Treasury using taxpayers' money to recapitalize the banks, only if. So that's one of the advantages. The other one is that since we're going to have a single supervisory mechanism all across the Eurozone, at least the Eurozone member countries, the regulatory burden and cost for transnational banks is going to be much lower. The cost, for sure, is going to be lower. So hopefully, the efficiency of these banks is going to be much higher.